Good morning, viewers. And today we have Mr. Anthony Heredia, the MD and CEO of Mahindra Mutual Fund with us. So, Mr. Anthony Heredia is a chartered accountant, and he has held various senior roles. Earlier, he was the CEO and Managing Director of Morgan Stanley Mutual Fund, and then subsequently CEO and whole-time Director of Bank of Baroda Mutual Fund, and then CEO of Bank of India AXA Investment Managers Mutual Fund. So now he is the Managing Director and Chief Executive Officer in Mahindra Mutual Fund, and he has extensive experiences and a very strong understanding of sales, marketing, investment domains. I mean, all around the mutual fund. That's why he is what he is today. And Mahindra Mutual Fund manages more than 21,000 crores of assets, of predominantly equity assets. And equity mutual funds alone, they have around 19,700 crores. Nearly 95-98% of their assets is equity. It's a very great thing, because most of the fund houses have 50% debt and 50% equity. Here, Mahindra's focus right now is predominantly on equity assets, where they can earn outstanding returns for retail investors. Welcome, Mr. Heredia. Sorry if I have mispronounced it. And glad to have you on our channel. I am sure that your insights will immensely help our subscribers.
Yeah, no, thank you, Mr. Palaniappan. And I must start on a lighter note. I was extremely impressed of the screenshot of the introductory. Both of us are extremely much younger in that screenshot. Obviously, we have aged. So thank you for being kind and using a photograph of mine that is clearly 10 years younger.
Thank you. But now just wanted to start from the state of Indian and world economy at present. There are a lot of confusions going on, and how are you looking at how is the status right now?
So I will try to look at answering this in two parts. The first part is that at the end of the day, and this part is actually much more relevant when you think of it from an equity market standpoint, maybe not so much as an economist viewpoint, but end of the day, when you are, for example, when you're buying a stock, when you're buying anything, value is always relative, right? It's like, is this stock cheap relative to its long-term averages? Is the growth of the earnings relative to past 5 years, 10 years? So if I use that yardstick, India economy and its current growth trajectory, its expected, I would say both qualitative and quantitative growth, is relatively in a much better place than almost every other part of the world. And it is relatively better, not just when you compare it to similar types of economies, but it is relatively better when you compare it to across the board, right? Because when you say that, how is it going to be relative to the rest of the world? In terms of its growth, the quality of that growth, I would say the certainty around that possible growth is in a far better place. When you cut to the rest of the world, I would say there's a very interesting thing that has happened in the last 2.5 years. If you actually think about it, the world across the board experienced a very common economic phenomenon, which is whenever any country came out of COVID, there was a super bump up in terms of economic activity in that particular country. And the view was that the only last major economy to come out of the COVID situation was the country that put us there in the first place, which is China. And if we were having this discussion exactly 2 years ago, the view on the world would have been that we see that the US is going through many challenges, likely to see recession, etc., 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 and it will be compensated by the return of China because they will be coming out of COVID, etc., etc., etc. Cut to today, you are actually having a situation where the US has continuously surprised in terms of growth numbers, and that has held up, to my mind, the world economy. And the China post COVID run up that was supposed to happen because it has happened to everybody else has just not happened. Now, that's, I think, the situation of the world economy today. In relative terms, India is in a much better place. In absolute terms, also, India is in a much better place. But the world economy, to my mind, has done all right, primarily because the US has surprised on the upside. There have been otherwise a lot of challenges in Europe. So I would say that you have to be selective. One of the other countries that people have not considered as a leader or a potential part of world economic growth is Japan. A lot of people are now taking the view that actually Japan could be a silent superstar amongst the large economies. Germany seems to be doing all right. So I would summarize by saying India, from a relative and absolute standpoint, I think is in a very healthy place. The world is in a reasonable place, but I think it is basically driven by too few countries, which is Germany, Japan, and the US. And within that, going forward, I do believe that the US will start to struggle because, in terms of, if you look at most of the recent numbers, it does seem that that expected cutoff in growth and that recession that everybody expected should have happened in 2023 late or 24 did not happen. People kind of assumed it's not going to happen. I actually think there's a chance that it's going to happen now in the next 6 months.
Okay, good. Good. And the one more thing which is hanging on us, nearby, India is nearer to Israel, Palestine, and then Russia, a little far away, Russia, Ukraine. This has done, the geopolitical tensions that is going on. Will it affect, Indian economy, and how do you see that?
So I would put it this way. I think the way both the current conflicts are currently playing out, it doesn't seem like it will have an impact. But the fact is that when you have something that is political, geopolitical, etc., you cannot forecast how it's going to pan out. And to my mind, then any flare up, and I would believe not so much Russia, Ukraine, because it has been in the works for 2 years now. The world has somehow found ways and means to live with it. There are public posturings in terms of sanctions at one level. There are practical compromises that virtually every country in the world, including the US, has actually made on in case of Russia, Ukraine. So I would believe the potential impact, unless there is something absolutely unexpected, which means that the conflict spreads beyond Ukraine into Latvia or Poland or some such situation. But I would believe that that's a very, very low probability. It's not something Russia would want in any case. So I would say that particular conflict, I see having very little impact at the moment, and I see very little potential negative surprise. Israel's conflict, on the other hand, I would believe for any investor, we would be very foolish to say that, oh, this is now seemingly going down the same path. Eventually, there will be a compromise, etc., etc. Because this is not a conflict that is been created over the last 1 month. I mean, I am a little bit of a history buff. I mean, I could argue that this is a conflict that has been a century in the making. There are decades of history and context. And therefore, any of those context or history is enough to spark a match into a very, very volatile atmosphere. And I would believe that that also has immediate correlations on a commodity that India has a large dependence on. See, in the last 1.5 years, a lot of people have talked very proudly about how when oil prices went back to 1995, nothing of the sort that happened in 2014 happened to us. we were able to tackle it, etc., etc. I don't disagree with it. But there is one thing coming at a situation from a very patriotic standpoint, saying, oh, we coped with it, nothing happened. And one thing, realizing that if you, and I'm sure we'll talk about this in the rest of the conversation, but maybe I'll use this opportunity to segue. When you think about the economic transformation that India wants to go through in the next decade or the next 5-7 years, energy is a very vital part of that transformation. And in that context, higher oil prices, to my mind, will have a very material impact on the quantity and quality of that transformation. And that can be something that is thrown out of the equation in terms of normalcy because of the Israel conflict. So to my mind, yes, I would keep a very close watch on that in terms of its implications, because I do believe, and maybe I'm being extremely, shall I say, exaggerated in that comment, but I'm not, I think, being absolutely fantasy land. But there is a possibility that World War III can start from this conflict. I don't see a possibility that World War III will start from Russia, Ukraine, etc.
Okay.
And therefore, it's always useful to just keep that conflict in mind and in context.
Okay. Okay. Sure. I do agree. So it will have major impact on our essential commodity, which is oil. It could have.
Yes.
It could have, and already we are feeling something to some extent. Anyway, so that is that. And now, generally, now when retail investors come for investment, they look for the next decadal opportunity, next 10 years, how India will be. And because they are, saving for their children welfare, for their, retirement kitties, all those things. So in that context, where do you see the Indian economy in the next 10 years?
So I'll tell you from a perspective of the last 10 years or the last 20 years. Sorry, was I audible? Because the screen blanked for a moment.
Yeah, it goes off. I think the signal goes off in your thing for some reason for a few seconds.
Oh, okay, sorry. Okay. Yeah, so let me first cut to the fact that actually, if you look at it, for the last 2 decades, Indian economy and therefore by definition, Indian equity markets have actually delivered wonderful things for retail investors who have invested 10 years ago and stayed put. I mean, that is also a statistical fact. The question will be, actually, if the next decade is forecasted to be even better than the last decade or the last 2 decades, then I think you just have to think about what 6 or 6.5% of GDP growth in last decade translated in terms of equity market wealth. And if for whatever reason 6.5% normative growth over the next decade, what is it going to translate to? And I would say from retail investor standpoint, or let me just say from any individual standpoint, why retail investor, right? For all of us, see, sir, you are a professional in this space. I am also a professional in this space. But at the end of the day, we are also investors. When it comes to our own individual, right? End of the day, if we have to combat the way inflation is going to be over the next decade, if we are going to combat the fact that aspirations of our generation and the generation below us is going to be materially different, then if we are going to live in a decade where for India, perhaps relative to the rest of the world, in 50 years from now, it will be written that perhaps this was the golden era, then I would believe that you will be taking a massive risk of staying away if you started to overanalyze. One of the biggest mistakes investors make is you actually believe that equity investing is about IQ. In my view, equity investing is never about IQ. It is about having very high EQ, emotional quotient. and common sense. If common sense tells you that over the next 7-10 years, our economy will potentially grow from 3.5-4 trillion to 7-7.5 trillion. If common sense or past tells you that one of the few markets in the world, US being the other, where the stock market is very diversified in terms of number of companies and sectors, therefore, brilliant high correlation between GDP growth and stock market cap. It's almost like saying it's a simple mathematical equation. If today the market cap of the index is, let's say, 4.5 lakh crores, if the GDP is 4 lakh crores, if in 2030 GDP is 7 lakh crores, what is likely to be market cap? Most likely 8 lakh crores. If I tell you in another way, therefore it means even if you just threw your money into a Sensex index option for next 7 years, highly likely that if you have 40 lakhs today, it will be 80 lakhs. Why will you start to intellectually discuss it? So to my mind, that is really the most fundamental thing that we discuss. What is going to govern your decision? Is the Sensex at 72,000 or the Nifty at 24,000? Is that occupying 80% of your brain space when you are making this call? Or is the $7 trillion Indian economy in 2030? I think if you choose the latter, the decision becomes very simple. If you choose the former, then I'm afraid that you will spend the next 6 months discussing and debating that only.
True, true. No, I do agree. Then there is one more, really bullish view among investors, analysts, economists, everybody. So like that, Indian economy and Indian markets are going to be a multi-decadal opportunity. I mean, like whatever, for 2-3 decades, China was growing at an abnormal higher rate. So now India was not in the manufacturing picture. So India has entered into the manufacturing space. Now they are already established in IT services sector. So it is going to be and the defense sector multiple. So it is going to be a multi-decadal opportunity, and I think Mahindra also believes that Mahindra Mutual Fund, Mahindra Manulife Mutual Fund also believes that. So why do you think it should be a multi-decadal opportunity for India? What are the drivers? I mean, generally.
So I think the drivers are a multitude of things, but I would say one of the larger drivers is where we are at our journey across many facets of an economy, where we are politically at the world stage, etc. We are extremely well positioned to take advantage of the opportunities that exist for any economy to grow. That is part number one. Part number two, why we say it is multi-decadal is because one way of looking at it is what I just discussed in the answer to the previous question, which is that, okay, India by 2030 highly likely to be the third largest economy of the world at 7 trillion, $7.5 trillion. But in that journey, there is another subplot which is happening, which is, to my mind, even larger, and which is what is multi-decadal, which is in that journey, is India finally making a move from being an emerging stroke developing country into a developed country. And I will put it this to you. It is not only China. You look at the last 50, 60 years, classic examples like not just China, but Japan, Korea is a standout example. When a country moves from developing to developed, that one way of describing it is multi-decadal. Another way of describing is once in a civilization opportunity, because you move from developing to develop only once in your life. It's like saying that today somebody is a teenager. My son, by the way, is 16, right? He's only going to turn 18. Sorry, I think it blanked and I stopped speaking because I was not sure I was audible.
Yeah. No, it was
So I
not.
said you can only become adult once, right? There are n number of benefits from becoming that adult. You can vote, you can drive, etc. So I would describe the first way I would want to describe the multi-decadal opportunity is in the context of India moving or any economy moving from developing to developed. Look at the massive wealth creation that happens in that journey and therefore try to capture it is one reason why you would look at it in that perspective. The second perspective is what will happen to per capita incomes in those journeys, right? So today an average Indian household is at $2,500. By the time it's a 7.5 trillion into consumption, it goes into investments, and then it's a virtual circular motion of good things that keep happening. Now, so that is the opportunity and what's going to happen. Now, the cynic in anybody will say, okay, this is all nice, very lovely picture, but why is it going to happen? What is it that is going to make that happen? And what is it that I should look out for as risk factors in terms of it may not happen? I would believe, and you touched on it, sir, earlier in your question itself, the large way or opportunity why our economy transforms, whether it is in this next 5-7 years, whether it is multi-decadal, is in manufacturing. Bear in mind that over the last 2-3 years, India's investment as a percentage of GDP is the second highest in the world amongst large economies just outside of China. And if this is going to continue to take place over the next 5, 7, 10 years, that itself, that is what has to transcend this economy. Because in other aspects, to be honest with you, you are not going to, it's not multi-decadal. Because, for example, agriculture, to whatever extent it is still a substantial part of our economy, there are enough constraints within that to believe that a transformation is not possible. Because there are too many conflicting interests, I would believe. For agriculture is not going to double or triple its contribution. If it is 12-14%, it's not going to be 28%. In services, there is a limitation of base effect, right? You have already done lots of excellent work in technology, IT, in generic pharma. There is only a limitation to which you can grow further, and also there is the emergence of artificial intelligence, etc., which will have a natural bearing on what happens. The large opportunity is actually the fact that we will have the largest number of consuming young people in the world sitting as domestic market, which will give any company or any corporate the firepower to invest in creating world-class manufacturing capacity and capability. And when that starts to transcend from import substitution to domestic consumption to export king, which has happened in certain sectors today, but if you think about it happening in virtually every sector and subsector over the next 1 or 2 decades, to my mind, that is going to be the driver. So manufacturing is, and getting that execution right, is the primary and only driver. Everything else is secondary. And I believe that we are in a good spot where the current government has understood this for some years now. So if you look at the direction of the government's reforms or policies, they're only centered around two things, right? Investment in creating infrastructure and incentives to industry to create products and goods that make sure that we do not import as much as we want to.
Yeah.
We are able to then serve our domestic consumption, which is a very natural growth area ourselves. And then we conquer the world, just like we have conquered the world in two-wheelers. Right? Some of the largest two-wheeler company in the world are here. I don't know how many people know this, but the largest tractor manufacturer in the world happens to be a company that I work for.
Mahindra.
Right.
Okay.
It is the largest tractor manufacturer, for example, in Europe and the US almost. So it's
Oh.
so this can and I'm not saying this is not the occasion to big up a Mahindra. I'm just saying there are actually wonderful examples, and those examples will become much more meaningful over time. That, to my mind, will drive the multi-decadal opportunity, or Viksit Bharat, as our PM likes to call it.
Yeah, as the government. Okay, okay. Good, good. Now that way, now, we all know that, okay, so now, I mean, most of the people are in the camp that India is going to lead, Indian economy is going to grow. So now, how can I harvest this opportunity? It is more important, understanding is one thing, and now harvesting that opportunity is another thing. So generally, retail investors, what should they do to harvest this opportunity?
So, sir, I'm actually going to say something that my sales colleagues hate me for saying it. Some of my industry colleagues also hate me for saying this. But I actually see that many retail investors are starting to make one error. That all of this explanation that I just discussed over the last 10-15 minutes means that equity is the best risk-free asset possible. That is the mindset going on somewhere today with people. As if
Got it.
sorry. So the first comment I would make is then, irrespective of what opportunity this multi-decadal, etc., is, core to your investment should always be an asset allocation linked to broadly your goals, and a portfolio that is ring fence from something going dramatically wrong that you couldn't foresee. So, for example, one of the products I believe that should be at least 30-40% of any client's portfolio going forward, because it's now available, is classically a multi-asset fund, which will, because if there is a multi-asset fund which has an ability to do fixed income, equity, gold, silver, and maybe at a later point commodities, that is one way of harnessing this opportunity. Because this opportunity is not going to be one-dimensional only equity. It can be in fixed income. That should be clearly, I would believe, 1/3 of the strategy. The second 1/3 of the strategy, I believe, should be in boring, diversified, flexi and multi-cap funds. People make a living, including people in mutual fund industry, I'll be honest with you, with creating new and new products. It's all old. There's the saying, right? Old wine in a new bottle. Very true. Having 5 or 6 good, decent flexi cap, multi-cap funds in one's portfolio is good enough. No need to wonder whether, sir, is small cap valuation high? Is a large cap I should do? Passive should I do? Active should I do? I often tell people it's like a Hindi movie. All Hindi movies, and I would argue also Tamil movies in large, but I do believe that Tamil movies have slightly better storylines most of the time. But let us go back to movies of 10 years ago, where script was not as critical sometimes. The start and the end. What is different is the middle, right? So the answer is very simple. If you know the end, you should also be prepared that sometimes the villain will seem like the villain is going to win. And you should have the emotional quotient to say, boss, I'm going to be here till the end of the show. So what do I care? I will watch, I will enjoy, as long as I know hero is going to win. So my answer is 1/3 should therefore be in a basic diversified fund. So we've got 2/3 covered. The remaining 1/3, I would say, add excitement to your life. Why? Because if there are certain themes that are going to play out that are going to be sharper, and I'm not for a moment pretending any of us know this, right? But for example, manufacturing, if you're saying, is arguably one of the biggest drivers to this multi-decadal opportunity. Thematic funds that play in that space are probably interesting. I also would bring into picture one day, not today, but 1 year from now. Yeah, I'm really sorry, but
If you want to move somewhere, it's okay. We'll take a minute or two. We'll do it. Yeah.
Hi, am I audible?
Yeah. Now you are audible. No, you want to shift the location to somewhere else?
No, I think we should be hopefully fine.
Okay.
Uh, yeah. So as I was saying, so 1/3 is multi-asset, 1/3 is a diversified equity product, which is primarily flexi or multi-cap, and the remaining 1/3 one could allocate to interesting thematic equity or more fixed income based on who the person is. Right? So if a person is much older and is more concerned about regular income, does not need so much excitement, the excitement portion gets converted into very boring. And for a younger person, it keeps being excited. So if you then make the equation back again, it's either excited plus diversified and multi-asset, or it is boring plus diversified plus multi-asset. To my mind, that's the basic simple formula for any individual investor that you should use over the next 5-10 years.
Right. Oh, okay, very good. Well taken. And Mahindra as a mutual fund, I think you started like 7-8 years ago, if I'm right, or 10 years, I'm not sure. So yeah, in your earlier part, subsequently when you joined hands with Manulife of Canada, now most of your, this is my personal view. So most of your funds started outperforming and doing really well. Many funds in the last 5 years, if I can put it, 4 5 years, they started really doing well. Is it because of the Manulife joint venture, or some other changes that you have made in the fund house?
So it's yes and no, and it's a perfect observation, right? We are 6-7 years old, but a lot of our success you can actually translate to about 4.5, 5 years, which is coincides with the Manulife joint venture. I would put it this way. It's not that because Manulife is doing certain things that are not visible to the naked eye, that's why we are doing this. What they basically said, and this is their experience from global markets, is that your market is also going to become one where investment performance will become the first right to win you must have. Everything else is secondary. Which brand you are, how good your customer service is, how friendly you are with the distributor who is taking your product, all of that is secondary. What is primary is investment performance. Unfortunately, nobody has written a book which tells you how to generate investment performance. What they've written is this is a business which is done and created by people. So when you talk about spending money, yeah, I'm sorry, I have changed because I don't know why it keeps switching.
Okay, I mean your network keeps switching, huh?
Yes, I think so.
Okay, no issue. Because of the Wi-Fi, or you can put off the Wi-Fi and just go with the.
Sometimes, yeah, I know that is the better thing to do, but I'm just hoping this time it should be a little better.
Okay.
Yeah, so coming back to that question, I really apologize to your listeners because we have these interference or too often. Uh, yeah, so I think the message was investment performance is vital. You can only control things like who are the people that are going to be trying to create that performance, what is the culture you're going to create in that investment room, what is the incentivization they have, are they aligned to your AUM growth or are they aligned to what they're delivering for the investor, right? Because ultimately investment performance is delivered to the investor. AUM growth is delivered to the shareholders. You could argue that. So alignment of the investment team should be with the investors, not with the shareholders. Those are certain DNA things that they brought into picture. And lastly, we were very fortunate. And I use this word not to try to appear humble, but to genuinely tell you, end of the day, sometimes this is just about luck. To get a bunch of people that have actually worked with each other at different organizations in the past, trust each other, and are able to, at one level, run portfolios independently, but also collaborate so they share their best ideas with each other. They know that this is not a race between them. This is a race as an organization that we are running. So I would say, yes, the Manulife JV timing was very much there, coincidental at one level, but it also, they played a role by saying, above everything else, investment performance is going to be the key determinant or differentiator. That, let me clarify, sir, it is not, we are not, we may be looking like we've had a lot of very good performances. That is not our intention. That's an outcome. Our intention is very simple. We should be above average every quarter. If you are above average or slightly above average every quarter, we believe that over 5 or 10 years, you would be, can be counted as one of the best performing people. Because if you try to replicate saying, oh, our small cap fund was number one or number two, now Abhinav, you must keep this rank up. It's a short strategy to come 28th next year. So it is to say, Abhinav, there is a God up there. He blessed you a little extra last year. So your above average turned out to be very, 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 very good. But let it be. Our job is above average. So I just want to place that into context. In our case, do not go by past performance, which is very good because that was an accident. It happened. Our job is, if India is a multi-decadal opportunity, if in any case things are supposed to be doing all right, if we deliver something above average, it will probably lead to happy investors. That's all we are looking at.
True, true, true. I do agree. Now you do your duty, then like Lord Krishna says, no, you do your Bhagavad Gita, do your duty, outcome will come automatically. So it's more like.
Yeah, in fact, I'll add, I don't know whether our vision statement is kind of similar. It's the Mahindra Group vision statement. It says, only when you enable others to rise, will you rise. That is the Mahindra Rise statement, which I believe is so true for our industry and for you and for all of us, right? Only if our investors rise, which means only if we create the wealth for them, will we rise.
Correct, correct. True. And now, do you have any plans to launch, any missing links in your portfolio schemes? Like I think you have, the equity, you have more or less full set, or we have plans to launch something?
No, so we actually do have approval to launch a thematic fund in the manufacturing space. Wow. Because we do believe that that does make sense from a long-term perspective. But you're right. In the equity space, I don't think there is much for us to offer right now. See, we don't want to be stuck with, because we will launch a fund, NFO gets money. That is a very big mistake that people make. So we have a pretty full range. Over the next 1 or 2 years, there are a lot more things on fixed income we would want to launch. We'll have to wait for an opportunity. But I would believe that the next set of innovations from us will be more on international investing opens.
Okay.
Because I just genuinely believe it's a matter of don't put all your eggs in one basket. India is great, lots of opportunities, but does not mean that there aren't possible good diversified opportunities. So I think that's what we'll do. But yes, I don't think you can expect too much of nice new innovative products from us. For us, boring is good.
Okay, good. All the plain vanilla, simple fun. Good. That is good. That's where most of the time people make money and can remain invested for long term. That is
Yes.
because today one industry may perform, tomorrow another industry will perform, but it is not the job of the retail investor to go behind it. Rather, the fund manager and the fund house takes care of it, and they give the money to the fund house. So
Yes.
I do agree with you on the plain vanilla product most of the time. We also follow the same thing. Most of the time, our things are, more of multi-cap, or for aggressive people, small cap, mid cap, so all those things.
No, I agree. See, I'm not saying no that I talked about a formula that I know that I will not be held accountable and say, oh, why did you say this? Obviously, there was a point last year, and we launched a small cap fund in December last year in 22, right? It turned out in hindsight to be an outstanding time to launch. So there are times when some pockets of the market will seem very, very, very attractive. But when you're talking about a 7, 8, 10-year view, it's very impossible to say that this part will outperform that part.
Sure. And now, what is your, advice to retail investors in general, from a fund house perspective or from your own experience? What would you like to share with our subscribers, to make their investment more disciplined, and what should they do and how should they, for what the methodology? Of course, you have mentioned your thought process, but in general.
No, in general, also I would say some of the same things. I mean, I wish in some ways I listen to some of my advice myself. Making sure that you are disciplined, making sure you genuinely put as much as you can to savings without compromising your life. I think that's really important. It's not about how wealthy you become. It's how rich your life is, right? That what the focus needs to be. I would believe, like I said, staying invested is very critical. Keeping it simple is very critical. And trying to make sure that a disciplined set of investing happens, which an SIP or an STP kind of route allows, is there. One advice I would give, this is based on what conversations I've had, particularly last 6 months. Equity has not and never will be the risk-free asset class. So many people today approach it and ask questions from a perspective more about how nothing can go wrong. I am convinced there will be a large correction in the next 5 years. There has to be. That is how equity markets are built. So you must remember fixed income. See, we are also sitting at a multi-decadal opportunity in fixed income. People don't realize it. How can you, have you seen 8% interest rates in any developed country? Never.
No.
So if today you can go to your bank and get an FD at 8.5% for 5 years from a good government bank, if you should buy a long duration bond fund, if the time is today, you will never see double-digit return in a bond fund over a 3-5 year time frame outside of the next 5-7 years, is my view.
True.
Never again. So, last message I would give to all your investors is, it's not only equity. Please diversify to fixed income, and that's why I also suggested, sir. That's why multi-asset is a great solution. So investor doesn't have to waste time thinking interest rate, either where it will go, what will happen. US Fed said this yesterday, somebody else said that tomorrow. Just have 1/3 of your portfolio in a multi-asset fund. Leave us to do the painful thing.
Good. No, do agree. And now the thing is, one more thing is, if I'm right, SEBI has a mandate for the fund managers and the people who work, key managerial person, to invest money into their own scheme. okay, in the own fund house scheme. So here, my two questions, but the answer could be same. You know, any fund category that you prefer in the current situation from your table. That is one. Second, where do you put your money as per the SEBI mandate?
Okay. No, so my answer first, I actually have different answers because my second answer is a very boring answer and doesn't help your subscribers. Because I am the head of the organization, my investment goes proportionately in every fund on the basis of what the weighted average AUM is. So I don't have a say. That being said, it doesn't matter to me because I believe all our funds are good. I will say, however, if I had a choice, I'll put it this way, sir. I know while you have lot of viewers across the nation, but a lot of them will be from Chennai, a lot of them from Tamil Nadu. Let me put it this way: if in Chennai Super Kings, who is the favorite? It tends to be Dhoni, right?
Yeah.
So my personal favorite in my stable is a fund that actually distribution partners and investors don't sell as much, which is my focused and business cycle fund, because that is run by Krishna Sangvi, who is my Dhoni.
Okay. Okay.
So I would believe that would be my, if somebody said, no, Anthony, you cannot invest in your 14 equity funds, pick only two. I probably would pick these two.
Very good. Very good. Good. I mean, I'm more or less, coming to an end, but I will have just let me write it down here for any questions, please. So that they might want to ask. Anyway. So the thing is, the final thing is, I would like to close this conversation in the things that you do when you are away from your work, or your hobbies, or your personal interests, or your family, anything you want to share with our subscribers.
So I spend my time primarily in two areas. One is I am very passionate. I think you can tell it from the T-shirt I'm wearing. I'm crazy about soccer. I played it when I was young. I don't have the fitness to do that, but I am an Arsenal fan. So watching soccer as much as I can is, and generally all sports, by the way, I'm one of these people who will wake up at 6 o'clock in the morning to watch Asian games as well. So I genuinely believe that sports has so many moments of enjoyment and learnings. So my hobby is I watch all sports. I try to play a couple, but soccer is clearly my favorite. And I also spend a little time working with an organization where we mentor young children, young teenagers, young adults from difficult backgrounds. Because what happens is today education is an equalizer, right? Because everybody goes to college, etc. But what a lot of these kids lack is guiding lights within their community. How do they proceed? See, if my child wants to do something, I may know something, I'll have 10 people I can ask and he speaks to or she speaks to. But these young kids, they don't. They have all the ability, but they can't. So we have this, I work with an organization called Take Charge, which is a mentoring organization for young adults. It's primarily Mumbai based, but so that's something that takes part of time because it's giving back. I think, the next generation is really what it is about. So these are the two things I primarily spend. The third is I try on not Saturdays, actually Sundays, over a beer, I cook. I love cooking as well, but not before anyone starts believing that I am a chef. No, I'm not. I just like to roast and grill. That's my restricted evening activity on a Sunday. So that's pretty much the three things that outside of work.
Okay. Probably when I'm in Mumbai, probably I will join you for cooking.
Yes, please, anytime.
Very good. Probably let me see if there are any questions here. So, we'll take a few questions and then close it. There is one Prasad Barbe. Good morning, sir. Your views on telecom sector. Now, specifically, is asking about the stock. Let us not speak about the stock, but telecom sector he is asking.
Yeah, so we are quite positive on the telecom sector as I think, I can't discuss specific stocks, but we are definitely overweight the telecom sector because we think that a lot of things that have to happen over the next 5 or 7 years, there are certain sectors which are very natural beneficiaries. I mean, it's you arrive at that answer by common sense, not by research actually. So I'll give you another example allied to telecom sector, right? And it's a large holding in all of our funds today, which is that $7 trillion economy. Everybody says yes, 100% is going to happen. When you do the math in terms of how much power consumption it is going to require, you discovered that that power consumption doesn't exist. Capacity does not exist. Yes, India signed up to COP and 2070 net zero, but obviously lot of power plants will happen, lot of generation of power will happen. Who and what will drive that? It is the coal, right? So
Yeah.
the only person who is in the most growth sector is the coal company, because the coal company, whatever they manufacture can be sold.
Sure.
It's like the, an Apple 16 is launched and you will stand outside the Apple store in Numagam High Road or wherever it is. So it's about thinking in that context. And while telecom is not in that space, I think the pricing pressures, etc., are behind us. There are two primary incumbents, one secondary incumbent. It has to be a big driver to whatever happens. So therefore, yes, telecom and allied to telecom sector, because there are some communication companies, etc., that may not be lobbed in that, is definitely something we are positive on.
Okay. Rajarajan is asking from which fund house. Mr. Anthony Heredia is the MD and CEO of Mahindra Manulife Mutual Fund. What is the main reason that most of the mid, large, and mid and large cap funds not beating its benchmark index? I'm not sure if this is true. He is asking most of the mid, large, and the large and mid cap funds are not beating the index. I'm not sure whether this is true. You can point out your thoughts.
No, so I think I would say that answer is about 50-50. I would believe 50% beat the index, but honestly, I'm going to say something that some people will not like, but I cannot understand this obsession between beating the index or not beating the index. The question is, are you invested or are you not invested?
Sure.
You can choose to use IQ and spend time on saving 20 basis points, or you can choose EQ and become invested and earn 11.8% instead of 12. Right? That is point number one. Point number two, every index fund underperforms the index. Actually, nobody sees that. Because so what somebody does is they compare an active fund to an index and then say that I should have bought an index fund. But dear sir, every index fund also has an expense ratio. So 50% of the large and mid cap active funds have underperformed the index. 100% of the index funds in large and mid cap have underperformed the index. And I'm also saying both these points are not relevant. What is relevant is, are you invested?
Correct. Now it is for the goals, rather than saving that for 0.2% or 0.5% or comparing. Ultimately, when you retire or when you want to have your kids go to college, you need some money. So whether
Sir, if you may permit me, I just want to make one comment. It will surprise people. Next year, October, I will cross 30 years in this industry. And I've worked with a lot of firms. I've seen a lot of, even I still use a distributor for my mutual funds. You know why? Do you think I do not know the funds? Do I not know most of the fund managers and CEOs by first name? I do. But you know what I don't do? It lies in my bank account. Till that distributor says, Mr. Anthony, by the way, if you don't mind, I know you are sitting and having YouTube conversation with Palinapan sir, but you have to also make this investment. So that discipline and that regularity is what the advisor and the distributor brings to me. If I did not have it, I would only have intelligence, I would not have wealth. I wanted to make that.
What you are saying is 100% true, because yesterday evening I had a conversation with one of the small business owners. Okay. So he is talking to us for the last 2 to 3 years. And the amount that they have as surplus is really huge. I don't want to say the amount, it's really huge. The problem at the end of the conversation, he himself told, since we talked, if I had invested that money in the last 3 years, it would have doubled by this time. So that is the indecision for many people. They instead of by thinking to save that 0.25, 0.5%, they lose the big picture. They lose the big picture. That is completely with you. There are a couple of more questions, then we will close it.
Yeah.
There is a question I think I don't understand, so I won't take. How does Manulife compare with ICICI Manufacturing Mutual Fund? So let us not take it. It's not clear to me. Then, Prasad, what are your views on telecom sector? Okay, that we discussed. Great listening to Antony Heredia MD. Straightforward. Thanks. Okay. What are your views on AI stocks? Whether AI stocks have a bright future? Manimaran, NS. So whether artificial intelligence stocks, whether they are available in India right now as a listed player, I do not know.
No, so it will be a surrogate play, because there are certain companies that would be allied to it, but I'll just answer it differently. I think AI is clearly going to be disruptive. When people remember COVID, right? Everybody thinks of COVID saying, "Oh, we are able to do all these calls on Zoom." They think about that. Nobody thinks about the fact that how did Tata Steel still produce steel? And ultimately, their use of technology differentiates company A from company B. So the same way, I think that the understanding of AI and its use can potentially differentiate the possibilities and prospects of company A or B. So I'm just taking the argument a little beyond AI stocks to say that AI can become a possible disruptor or an enabler for certain companies to go to the next level. One should keep a watch out for it. Specific AI stocks, I would believe, will still be available primarily overseas. That's my judgment. Because one of the things with the technology, and I should have mentioned when, sir, you asked about your passions. I like technology. I like to understand it. My son is in that space a little bit, so it's partly because of that. But the thing with AI is that it's a technology that is principally in the US right now. Right, it'll take about, to my mind, 5 to 7 years for other companies to become proficient in terms of the writing of the AI codes. It's otherwise, that's the beauty of the US, right? That's why it remains the foremost economy, because of the innovation and the discovery. So I would believe that if you're going to specifically look for AI stocks, look out at some juncture for either a feeder fund in India that is specifically doing AI related stocks, or an internationally available ETF, which you'll have to use the LRS route to buy, etc., etc.
Okay. And then, Rasan, he is asking, considering peak market conditions, should we hold SIP and direct equity investment till some correction happens?
So I'm saying great question, because at least somebody is worried about markets. So many people actually otherwise think nothing can go wrong. See, don't ever decide to hold your SIP, because that is otherwise you're starting to deploy IQ on the subject. IQ doesn't work. SIP should keep happening. When you say direct equity, if you happen to be buying stocks yourself directly, good luck. I'm assuming you understand those companies extremely well. If it is because some friends understand it and they've told you when to get in, that's also not a bad idea. Make sure you keep that friendship going so they tell you when you have to get out as well, because that often happens. You meet somebody at a party, somebody says, I think it's a great company, this is what will happen. You say, okay, I'll buy it. Now I have to hopefully attend the same party 3 years from now or 2 years from now, and the person will say, boss, the story is over. But be that as it may, I believe given broad valuations, if your equity allocation in your overall portfolio is where it should be anyways, then yes, I believe given valuations today, you should be in a staggered manner, not go all in right now. That's my view.
That brings us to an end right now. Thanks for taking time out on a Saturday morning for our subscribers, and this will be live on YouTube. I mean, this will be a recorded video in the YouTube live section, so people can view at any point of time. So, thanks for taking time out and answering all questions and more. Without any presentation, anything, all directly from your mind. Thank you so much. Now, probably when you are in Chennai next time, probably please do drop by our office.
I will 100%. And the invitation to you is likewise when you're in Mumbai.
Sure. Thank you. Have a good day, wonderful day ahead.
Thank you so much, and thank you to you for the invitation, and wishing all your subscribers, investors, and viewers also a very happy and calm journey.
Thank you so much. Yeah.